Welcome to Small Practice Support Information Session number 13. In this recording, Revenue provide an overview of the new Employment Wage Subsidy Scheme, of tax warehousing, and of personal income tax.
So you're very welcome to the Law Society Small Practice Information Session 13. I'm delighted to have members of Revenue's temporary wage subsidy scheme and people part of the further team. So you're very welcome, and thanks very much for coming along today. I know there's huge interest in the employment wage subsidy scheme, formerly known as the temporary wage subsidy scheme, and some of the other offers that have been put in place by Revenue. So I'm delighted to have Anne Delay, Garrod Murphy, Pat O'Shea, Laura Glancy, and Siobhan Gilmore, who's going to lead off to discuss the employment wage subsidy scheme. So Siobhan, you're very welcome, and the rest of the team, to the Law Society's information session. So without further ado, I'll hand you over to Siobhan.
Thank you very much, Justin, and good afternoon, everyone. Firstly, I'm going to stop my video just so you can concentrate on the slides and to make sure the bandwidth and all that stays put. So very good afternoon, and Justin, thank you very much for organising with the Law Society to invite us along to talk about the end of the temporary wage subsidy scheme and to get more information out about the employment wage subsidy scheme as well. So I'm going to go through, just as I said, the ending of the temporary wage subsidy scheme, and then I'll move on to the employment wage subsidy scheme. So just firstly, I want to give you some statistics for the temporary wage subsidy scheme as of the 27th of August, which are published on the Revenue website. 69,500 employers registered for TWSS, with 66,200 receiving payments, with 659,500 employees availing of support under TWSS, paying out 2.736 billion, including tax refunds of around 151 million. So just with TWSS moving forward, I'm going to go through how employers stop operating the scheme, the compliance check program, reconciliation, and the end of year review. So employers have had the option at any point of the TWSS to stop operating the scheme, and this was done by them simply stop making a J9 submission and returning all employees to the normal PRSI class. Payments under TWSS are paid to employers on a pay date basis, not an earned basis. So on the closing of the TWSS, which was the 31st of August, Revenue will no longer accept J9 PRSI class payroll submissions, unless this is the normal and correct PRSI class for employees. Payroll submissions received with pay dates up to and including the 31st of August will be processed for subsidy under TWSS for eligible employers in relation to eligible employees. And payroll submissions received with pay dates on and from the 1st of September 2020 will be processed for subsidy under EWSS for eligible employers in relation to eligible employees for whom the subsidy is payable. So effectively, that means the pay dates will determine the eligibility for either the TWSS or the EWSS. The employer must retain all records for the operation of the TWSS, including subsidy payments to employees. This will be important as we move into the reconciliation phase, and employers operating TWSS will be included in the reconciliation phase, and a list of employers will be published on revenue.ie at the end of the scheme. So moving on to the compliance check program. So to ensure the TWSS was operated correctly, Revenue is conducting a program of compliance checks on all employers who availed of the scheme at any stage. Letters are issuing to employers and their agents where relevant, mainly through the My Inquiries inbox. Revenue teams are working these cases in batches, so if employers have not received anything yet, just keep an eye on that inbox for correspondence, as there is a turnaround time on these letters. And it's essential that employers respond promptly, as failure to do so may lead to suspension of future payments. And it's just important just for employers to contact the Revenue caseworker they're dealing with and inform them that you're working to get the relevant information to them. So the letters are to confirm that the employer has met the eligibility criteria, so they will be asked for details of business activities, the negative impact suffered if the business was closed, they will be asked to provide the date of closure or date of disruption. And if they were unable to pay normal wages or outgoings, they may be asked to provide financial details to support this, and also details and evidence of the basis for meeting the reduction in 25% turnover test. The check also ensures that employees have received the correct amount of subsidy and that it is being recorded on the employee pay slips. So they may be asked for evidence to support this, which will include a sample of copies of pay slips. So the compliance check is not part of an audit or intervention. The contact is a request for information to provide assurance that the scheme has been operated as intended by employers. In addition, the compliance check programme will address any issues identified in respect of the operation of real-time PAYE or PMOD by employers over 2019 and 2020, and will provide an opportunity for employers to address any other outstanding tax issues they may have. This will be of importance to employers who may intend to avail of the debt warehousing scheme for employer PAYE and VAT liabilities that were incurred during the pandemic period, as up-to-date compliance will be a prerequisite in order to avail of the scheme. To date, we've had a positive response to this programme, with most employers responding within the required time and providing the requested documentation. And again, I just want to remind you, it's important to keep checking the My Inquiries inbox for that correspondence if you have not yet received the letter, and just make contact with the caseworker when you do receive the letter. And you should get a notification into the inbox stating when the check has been completed. So moving on to the reconciliation phase. So this is currently in development and testing phase, and detailed guidance is available on in the TWSS FAQ document on the Revenue website. So essentially, Revenue will reconcile each employer who operated the TWSS on all refunds paid to the employer against the amount of subsidy payable to each employee per pay date. So as you might remember, back in March, the employer refund scheme was launched, and then TWSS was launched, and Revenue refunded the maximum amount of subsidy of €410 per employee to employers, regardless of the subsidy that was paid. And as we moved into the operational phase on the 4th of May, Revenue provided all the necessary details regarding employee subsidy amounts to the employer on a CSV file to ensure the correct amount of subsidy was paid to the employee and refunded to the employer. So this gives rise to the requirement for a reconciliation of those balances from the transitional to the operational phase of the TWSS. So the reconciliation process has two stages. Stage 1, employers are required to report the actual subsidy paid to their employees for each pay date by the end of October 2020. And Stage 2, Revenue will determine the amount of TWSS, if any, owing back to Revenue from employers. Each active each active payslip will be reconciled. This stage is due to commence in October 2020. During the reconciliation, all active payslips will be examined and the subsidy payable amount for each will be determined. The sum of the subsidy payable amount will be compared against the cumulative refunds paid to the employer and a statement of account. And as previously mentioned, as part of the reconciliation process, the employer will report the subsidy paid amount to Revenue. This is the amount actually paid by the employer to the employee in terms of subsidy. So the reconciliation will calculate the subsidy payable. This is the subsidy the employee is due based on the rules of the scheme as set out in Section 28 of the Emergency Measures in Public Interest, the COVID-19 Act 2020, and the subsequent determination by the Minister for Finance on the 16th of April when the scope of the scheme was expanded. The calculation will then look at subsidy paid, which is reported by the employer, subsidy payable as calculated by Revenue, and a third category, caseworker resolved. And this is where the caseworker manually calculated the subsidy due on a payslip based on the rules of the scheme, as well as additional information provided by the employer. There are three options for employers to report subsidy paid under both the TWSS and the employer refund scheme, and can be reported through either. The first one is direct reporting through payroll. Many of the payroll software packages allow the employer to include the subsidy payment information as part of the payroll submission. Employers will need to check with their payroll provider to determine the dates from which the payroll software was capable of reporting subsidy payments, and ensure that all subsidy payments are reported before commencing reconciliation. And employers can make such subsidy pay submissions now. The second one is CSV upload available in ROS. So some of the payroll software packages will generate a subsidy paid file for the employer to upload to ROS to report the subsidy paid. And employers wishing to use the subsidy paid CSV file upload can upload the prescribed format CSV file containing the subsidy paid details. And this feature should be available in ROS in late September. And the last one is the revenue payroll reporting in ROS. So the employer can report the subsidy paid by manually reporting the payroll notification in ROS. The employer can access payroll reporting in ROS and report the subsidy paid by including an amount in the other payments field. This feature is currently available, and it would probably be more useful for employers with a smaller number of employees. So once the employer has provided subsidy paid amounts for all active pay slips, this will trigger the reconciliation process, and it's envisaged that the reconciliation calculation will be available in October. The amounts will be included on a reconciliation CSV file, which will be available to download, and a message will be sent to the ROS inbox advising the employer or agent that CSV is available for download, and a statement of account will also be sent to the ROS inbox with the reconciliation totals. And there are detailed instructions in the TWSS employer FAQ document in section 6 on the revenue website, which will give you all this information on reconciliation. And just one final note on that, for employers making refunds of TWSS back to revenue, there's a new RevPay facility available. Employers are requested to no longer use bank details or EFT methods as previously advised, but ensure that only amounts of temporary wage subsidy scheme payments are repaid to revenue, and not to include any payments in respect of income tax and USC refunded. Any repayment of income tax or USC should be separately paid under the PAYE EMP to ensure the payment is correctly reflected in the employer's PAYE EMP balance. Just moving on to the employee end of year review. So TWSS payments are liable to income tax and universal social charge, the USC, and the pandemic unemployment payment, the PUP, is liable to income tax. These are not or have not been taxed in real time through the normal PAYE system, but they will be liable for tax and USC by way of an end of year review for the employee. When this end of year review is carried out, should an income tax liability arise, it is normal revenue practice to collect any tax owing in manageable amounts for the employee. And this is done by reducing an individual's tax credits for a future year or years in order to minimize any hardship. In this instance, reduction of credits will be from 2022 and may continue until 2026, depending on the circumstances of the employee. If an employee wants to make a payment back to revenue, they can also do that. And additionally, an individual may have tax credits to claim in respect of the year 2020. So for example, health expenses, and that could be used, or they might be able to use that to offset any possible liability. So when the continuation of the TWSS was announced to the end of August 2020, in order to further minimise the liability at the end of year, revenue placed all employees that received payments under either the TWSS or the PUP on a non-cumulative week 1 basis. And this was a further attempt to minimise the liability or hardship for employees. Employees on TWSS placed on a week 1 basis will continue on a week 1 basis until the year end, and employees not previously on TWSS, where their employer is joining EWSS, will be taxed as normal in real time. And I'll talk to you a little bit more about that later. So now I'm going to move on to the Employment Wage Subsidy Scheme, so the EWSS. So just the transition from TWSS to EWSS. So as I mentioned, the TWSS expired on the 31st of August, and no new employers have been able to join the scheme since the 31st of July. So the EWSS, as announced by the government on the 23rd of July, will run from the 1st of September 2020 and will continue until the 31st of March 2021. However, employers who were not eligible for TWSS or who had employees not eligible for TWSS can claim EWSS in respect of these employees from the 1st of July. These will be dealt with as part of a sweepback mechanism, which is currently under development, with a proposal for payment of those cases being made in mid-September. And it's important as well just that employers know that they must register for EWSS. And just some statistics, as of this morning, over 24,390 employers have registered for EWSS. So under EWSS, the employer will pay the employee their normal gross weekly wages. Revenue will pay the subsidy via EFT directly to the employer in respect of each eligible employee following submission of the normal payroll return. Legislation for EWSS was signed into law on the 1st of August, and guidance material has been published on our website since the 14th of August. There is an update to our guidance material, which we are expecting in the next couple of days. And it's just important for people to refer to this in the first instance to answer any queries you may have. And it will be updated regularly with any changes. And then, as mentioned, Q4 2020 will see the reconciliation phase happen, and EWSS will cease at the end of March 2021. So moving on to the key features of EWSS. So seasonal and new hires are included and backdated to the 1st of July, as mentioned, subject to limited exceptions, with payments expected to be made by revenue in mid-September, and then payments for subsequent periods being made monthly in arrears thereafter. Employer and employee eligibility and tax clearance. I'll talk to you a little bit more about this in the next few slides. Just one key point to note that employers must have tax clearance to register for EWSS. So publication, so as with the TWSS and in line with international practice, a list of employers availing of EWSS will be published in 2 tranches. So the first will be in January 2021 and the second will be in April 2021, and they will be published on the Revenue website. Registration for EWSS went live on the 18th of August, and you can register through Ross on My Services page. Click the Manage Tax Registrations in the Other Services section, and then just click Register next to EWSS. The subsidy is a flat rate based on the employee gross weekly pay, and I'll talk to you about those rates in the next few slides as well. EWSS will be operated through normal payroll and taxation systems, so employers will be required to operate payroll taxes in real time on all gross payments made to their employees. In relation to the PRSI rate, while employers are required to report and pay the full rate of employer and employee PRSI on receipt of payroll submissions, revenue will apply a reduced rate of 0.5% in respect of employees for whom a subsidy is payable. Employer monthly liabilities will be revised accordingly, and any resulting PRSI credit will be available for offset against future employer liabilities. And then just finally on this slide, there are safeguards to minimise the abuse of the system, and I'll talk to you that a little later on as well. So employer eligibility. To qualify, employers must be able to demonstrate to the satisfaction of revenue that their business has been significantly disrupted by reason of COVID-19, and they must demonstrate at least a 30% decline in either the turnover of the employer's business or in orders received during the period the 1st of July 2020 to the 31st of December 2020, as compared to the same period in 2019. Excuse me. So in cases where the business of the employer has not operated for the whole of the corresponding period in 2019, the following will apply. Where the business operations have commenced on or before the 1st of November 2019, the 30% decline test must be determined in 2020 by reference to the same period in 2019 in which the business was in operation. And where the business has commenced after the 1st of November 2019, the employer must be able to show that the turnover or orders during the period 1st of July to the 31st of December 2020 will be at least 30% less than what the turnover or orders would have been had there been no disruption caused by COVID-19. So as I said previously, employers must have tax clearance to be eligible to join the EWSS and must remain tax clear to continue receiving the EWSS benefits. In order to qualify for tax clearance, employers must be compliant with all obligations under tax legislation in relation to the filing of tax returns and payment of taxes. However, if you have filed all your tax returns but are not in a position to pay all your tax liabilities, and have tax debts that cannot be warehoused under the COVID-19 debt warehousing scheme, you can still obtain tax clearance if you entered a phased payment arrangement, and this can be done through the Collector General's office. Where an employer files a payroll submission for EWSS but is not in possession of a tax clearance, a warning will issue advising that tax clearance is not in place, and hopefully this will provide adequate notice to employers to regularize the position prior to the return due date, that being the 14th of the following month, to ensure the employer gets the payment of the subsidy. So it's very important for employers to check their tax clearance, and you can check your tax clearance status in ROS. So after logging in, current tax clearance status is displayed in blue writing above the grey banner for the My Frequently Used Services. And if an employer does not currently hold tax clearance, an application can be made online and assessed in real time through the ROS e-tax clearance service by selecting Manage Tax Clearance under the Other Services section on the ROS home screen, and follow the online instructions while selecting EWSS as the reason that the tax clearance is being applied for. Employers are also required to review the eligibility criteria at the end of each month from August 2020 to February 2021. If, as a result of the review at the end of each month, it transpires that the employer no longer qualifies, they should withdraw from the scheme on ROS with effect from the first day of the following month and cease claiming the subsidy. This review is to ensure the projected turnover or order reduction of at least 30% for July to December 2020 remains valid and does not require adjustment based on actual trading results to date, together with other developments in the employer's business or the marketplace, which may impact on projected turnover for the 6-month period. So if you find yourself deregistering, employers can re-register if a review during the following months shows that they once again expect a 30% reduction for July to December 2020, and this registration cannot be backdated to encompass the period where the 30% reduction was not expected. So moving on to employee eligibility. As mentioned, employee eligibility has been extended to seasonal workers and new hires, and they will be included in the sweepback facility to the 1st of July 2020. Childcare business is registered in accordance with Section 58C of the Childcare Act 1991 are also included in the scheme. Non-TWSS employers or non-eligible TWSS employees are eligible from the 1st of July through a sweepback mechanism, and revenue will pay the subsidy in these circumstances as soon as practical after the 14th of September. So where an employer registered for EWSS is making a claim for these cases, they will be required to provide employee information, including employee name, PPSN, employment ID, electronically using a template, which will be available on revenue.ie shortly. And once this information is received, Revenue will upload information and calculate the total subsidy due to be paid. The subsidy will be paid into the designated bank account as soon as practical after the 14th of September. There are no restrictions under the Transfer of Undertakings Protection of Employment, so the TUPE arrangements, provided such recruitments or movements are undertaken for bona fide business purposes and not with the intention to maximise subsidy claims. So there are some restrictions to certain categories, there are some restrictions and certain categories are specifically excluded in the legislation, such as proprietary directors and connected parties. So for proprietary directors, in recognition of the role played by certain proprietary directors in providing employment to others, especially in the SME sector, it has been agreed that EWSS can be claimed in respect of certain proprietary directors. On the 31st of August, Revenue confirmed that EWSS can be claimed in respect of proprietary directors subject to the following conditions. So where the employer meets the eligibility criteria for EWSS, where the proprietary director is on the payroll of the eligible employer, and where the proprietary director has been paid wages which were reported to Revenue on the payroll of the eligible employer at any stage between the 1st of July 2019 and the 30th of June 2020. And detailed guidance and further conditions will be published shortly around this. And connected parties who were not on the payroll at any time between the 1st of July 2019 and the 30th of June 2020, So that'll be brothers, sisters, aunts, uncles, nieces, nephews, etc. And this will also be included in the guidance document that we're expecting to be published shortly. So registration for EWSS went live on the 18th of August, and the employer, their agent or payroll provider can register for EWSS. The registration is through Ross under Manage My Registrations, and there is a self-declaration to be made there. Registration applications will only be processed if the employer is registered for PAYE, PRSI as an employer and has a bank account linked to that registration, and they must have tax clearance. And it's important to look into the tax clearance as soon as possible, and if you need to get your tax, just to get your tax clearance up to date. Moving on to the subsidy rate. So the EWSS subsidy rate is a flat rate to the employer and based on the employee gross weekly wage. So that's unlike what we saw for the TWSS. So where an employee's weekly gross pay is less than €151.50, there's no subsidy payable. Where the employee's weekly gross pay is between €151.50 and up to €202.99, the subsidy payable is €151.50 per week. Where the employee's weekly gross pay is between €203 and up to €1,462, there is a subsidy payable of €203 per week, and where the employee's gross weekly pay is over €1,462, there is no subsidy payable. So operating EWSS. So as mentioned, the subsidy is based on the employee's gross weekly wage. The gross wage includes notional pay before the deduction of pensions or salary sacrifice, but excludes any DASP benefits, which employees may have mandated to be paid to the employer. So for example, illness, maternity, or adoptive. Where pay frequency is other than weekly, the employer will calculate the gross weekly wage and divide by the number of insurable weeks to a maximum, and we are going to issue guidance around these limits. Where payroll is monthly, if employers are found to manipulate the system by changing pay frequencies, pay dates, or altering amounts to maximize subsidy, they will be liable to recoupment of the subsidy received, together with interest, penalties, and possible prosecution. The EWSS is returning to normal payroll process for PRSI, PAYE, and deductions with the payroll being taxed in the live environment. The EWSS indicator will not be the J9 as was the case with TWSS. It will go back to the normal class using the other payments field on the payroll submission with a value between 0 and 1 to indicate the subsidy request, and this will not appear on the employee payslip. Payroll submissions are to be made to revenue by the return filing date of the relevant month, so that's the 14th of the following month. And where there are multiple employments, each eligible employer makes a claim for subsidy in their own right for the eligible employee. You'll be glad to know I'm on to my last slide. So the Act includes a specific anti-avoidance provision which seeks to counteract contrived situations where the gross pay due to an employee is deferred, suspended, increased, or decreased with a view to securing the wage subsidy, or in situations where an employee is laid off and removed from the payroll and replaced with 2 or more employees in relation for whom the subsidy would be available. If revenue identify any such cases, the employer will be treated as having never been eligible for the scheme and will be required to repay subsidy monies and PRSI credits received in full, together with interest, and may face possible penalties and prosecutions. Employers should retain all evidence and supporting documentation of their operation of EWSS, as compliance checks will be undertaken, and there will be compliance checks on a percentage of employers operating the EWSS on a random or risk basis. So that brings me to the end of the presentation. Thank you very much for listening. And as mentioned, there is a guidance document available on revenue.ie for EWSS, and we're expecting an update on that shortly. And there's also information under the July Stimulus Hub that may be useful. And thank you very much. And I'm going to hand you back to Justin now, I think, for the Q&A. Thank you.
Well, thanks very much, Siobhan, for bringing us through that. That's really helpful. We've got some questions coming through on the chat. Some people were saying that they had a little bit of a problem on the chat, but I think it's working now. So Will we start those questions now, Siobhan? Are you happy for me to start asking some questions?
Yes, once everyone else
So
is happy to
the
answer.
first question here from Jack, my namesake Jack. If there is a liability for the employee for PRSI and USC, is there any issue with the employer paying that? Would revenue treat such a payment?
Gerald Murphy here. Justin, how are you doing? And many thanks to the Law Society and yourself for facilitating this particular session to cover the various wage subsidy schemes that the government have announced and that we're trying to operate on their behalf. Anyone who's been on the temporary wage subsidy scheme, the amount of money or the amount of subsidy that was paid was actually deducted as a non-taxable payment at the time. Knowing that we put this together in a mad rush, so we knew that we would have end-of-year liabilities, and because that amounts of money are actually liable at the end under the end of year process. In that regard, we're putting together more information for the employees and on what to expect and how that will work. On the question of an employer paying that amount of money, that's one issue that we're actively considering as to the few circumstances where an employer may be able to pay the full amount of money due to by their employees and what the implications of that will be. So okay. A little bit more detail to be provided later on is the answer.
And here's another query that seems to have come up a few times: is if you're unsure about this 30% reduction in your turnover, how, with regards to legal services, it's not always clear cut. And how are you going to treat that if you remain on the scheme and it turns out that you weren't down the 30%, or if you figure out you don't apply for it now and then you figure out at a later date that you should really have applied for it, how will all of that work? So if you could give us a little bit of a brief understanding of that, that'd be really appreciated. Thank you.
Hi, Justin. Angela here.
Hi,
I'm just going to deal with the EWSS queries. There's a couple of different aspects to that question. The 30% reduction is a rolling test, so people are to look at it at the end of every month just to ensure that they do remain eligible. As the term goes on, it's going to obviously become more accurate because you'll be including projections for a lesser number of months. So we do understand that in exceptional circumstances, situations change. So people may initially expect to be eligible and then turn out to be ineligible part of the way through the scheme. So they just have to be registered from that date. If someone does their projections at the start and it transpires that things don't turn out as well as they originally expected, so they become eligible part of the way through the period, then they can register from that date, and any wage payments from that date will be eligible for the subsidy to be claimed in respect of them. There'll be no backdating of registration or of subsidy claims. It's just in respect of any claims that are submitted for payment made after the date of registration. We're also getting some questions around turnover, and I think that was one element of the question you asked around how do you determine what's included in turnover, particularly in professional services firms. And the definition of turnover and rules around how to account for turnover are well set out in your general accounting standards and company law. So that's what is to be applied. The introduction of the wage subsidy schemes haven't changed any of the normal accounting standard or general rules around turnover recognition and revenue recognition. So you just apply your standard accounting rules and use that as your measure of turnover when determining whether you will have the reduction of 30% or not to make you eligible. So I hope that covers it, Justin. If there's something that needs clarity.
So there was a small query on that, but I think you've kind of answered it. But what's the difference between turnover or orders? And I think that you've indicated that it's clearly laid out in the tax rules.
Yeah, well, turnover is your actual turnover per your financial statements, and orders then are your business orders, and it tends to apply more to businesses that maybe make bespoke products, or to places like hotels or restaurants who have booking systems, more so than it may to some of your professional services firms.
Yeah, and I suppose here's another question around your turnover. Like it could be cyclical in this circumstance. So are you making a comparison with 2019 in that situation, or how does it work? How does that?
Yeah, your comparison is July to December 2020 as against July to December 2019. So even if it is cyclical, you're comparing it with the same 6-month period in the previous year. So that will avoid any deviations because of the cyclical nature, impacting your reviews. So by actually comparing it with the exact same 6 months in the previous year, you're ensuring that you're comparing like with like.
Okay, thanks, Anne. So a question there around a proprietary director working in the business on a Class M. Are they eligible for EWSS? And if I might, also, in the case that employers must pay, is it the case that employers must pay income tax on the benefits received under the EWSS? Is it fair to ask those two questions at the same time?
Okay, so the first one on proprietary directors, there is no distinction between the rate of PRSI that someone has to pay to be eligible if they meet the other criteria around employer eligibility as a proprietary director. That being that they were on the payroll and paid at any time between July 19 and June 2020. Now, the second part of that was whether employees have income tax liabilities in respect of subsidies they receive. Justin, is it?
Yes. Well, it's
okay,
not clear. It says, in that case, is it the case that employers must pay income tax on the benefits received under the EWSS scheme?
It's a reduction in the cost of the wages to the employer. So basically they'll be taking a reduced deduction against their turnover for their wage costs for their employees because it was partly funded by the government through the employment wage subsidy scheme.
Okay. Here's another question. I have an accurate account of the refund due to revenue. Did I understand correctly from Siobhan to say that I should not reply to EFT?
That's under the temporary wage subsidy, I believe that. No, we'll be writing to everybody in the near future, setting out exactly how to refund the amount of money that we overpaid employers during the temporary wage subsidy scheme. And we'll be setting out exactly how that will work. We have a repay option there, which operates and we'll be operating that. So there'll be far more detail on that. I'm glad they've kept an accurate account. That'll make life a lot easier for us all in this regard. So thanks to Lillian.
Okay. Business that can't open due to COVID-19 but would like to continue to pay staff, is this okay to do so under the EWSS scheme as the company has not enough reserves? So this is a close.
There is no requirement that the employees actually have to be working, and there's no requirement that they have to be full-time or part-time. The test is just the amount of wages that you actually pay to an employee in a particular pay period, and that determines the quantum of the subsidy that you're entitled to receive in respect to the employees. As I said, no requirement around having to be working or having to be full-time or part-time.
A question there for a company that has no trading history, i.e. a new startup or somebody who's just started recently. And how do they document that there's been a 30% reduction in their turnover?
Okay, that has been envisaged as well in the legislation, and the test is that you would have prepared projections before the, that it's expected that you may have projections prepared before the pandemic hit us, and if not, that you would be able to put together some reasonable projections as to how your trade would have manifested itself and what level of trade you would have had without the pandemic having hit us. So you compare your new revised projections now that were affected by COVID-19 as against projections that you would have put together if we weren't in the middle of the COVID-19 pandemic. And if there's a difference, a reduction of 30% between your new projections and what would have been projected if we weren't in the middle of COVID, then you're an eligible employer.
Okay. This is short. Is the test for employer qualification to be extended to January to March 2021? If that makes sense.
No, Yeah, it does make sense. No, the eligibility, while EWS can be claimed up to the end of March, the turnover test is only up to the end of December. Now, there is a requirement that you would continue to undertake a review of your eligibility at the end of January and the end of February. That's just because sometimes we do see that there's post-year-end events that affect the turnover that you would have maybe accounted for when you were looking at the actual results initially at the end of December. So we do require that you would continue to do the monthly review for eligibility at the end of January and the end of February, even though the results for those 2 months and the results for March don't, the actual results for those months don't impact, they're not part of the test.
Okay. The question here is where a business have a high cash flow balance and large amounts are still coming in through work completed pre-COVID-19, how can such business claim reduction in turnover? This again is the turnover issue. And another question there also around if turnover is down, say 15%, but file openings are down 50%, can you still qualify? So there's 2 questions there.
Yeah, you're back to your normal accounting standards and all the general accounting principles around how to account for turnover. So as I say, you have to just look and prepare your accounts and speak with your accountant around how you would account for items like that when you're looking at your turnover test, and they'll help you decide whether you're actually eligible or not. As I said, there's no difference and no change in how turnover is to be accounted for as a result of the subsidy schemes.
Okay. What happens when an employee wages have been deducted at 30%, but the employee does not apply for the subsidy?
I'm sorry, will you ask the first part of that again?
What happens when it's the 30%, but the employer, I'm assuming, it does not apply for the subsidy?
So you're saying the employee's wage is reduced by 30%, is it?
Yes, but the employer didn't apply for the subsidy, is my understanding.
Okay, well, the subsidy as well doesn't have any impact on the level of wages that are legally required to be paid to employees. That's a separate legal agreement between employer and employee. So, you know, whether wages are reduced or not is irrelevant in relation to whether you're entitled to a subsidy or not. As well with the employment wage subsidy scheme, it's a subsidy payment to the employer. It's not a subsidy payment to the employee. And the employee even doesn't necessarily know whether you're claiming in respect to them or not, which is why there's no note of it on the payroll to the employee.
Okay, I'm just going to take a last few here on the EWSS because I know there's a lot of queries there around the end of year tax returns and the tax warehousing. So there's a query there about somebody who's looking to repay money back to the revenue as it no longer applies to them. How might they go about doing that? So their turnover. Yeah.
I'll take that one. Yeah, no, we've given guidance on that in our FAQs on our website. So it's important for anyone who has a question of that nature just to go to the FAQs and read there. It's give very precise guidance that's been provided there as to actually how people can pay money back early on if they so wish.
Thank you. Somebody there is just having difficulty contacting revenue with regards to the temporary wage subsidy scheme. They are saying they are finding it difficult to contact and get, so they're looking for somebody to call. But in general, how would you advise somebody who's having difficulty contacting or getting in touch with revenue? How's the normally? Process.
Yeah, normally, yes. It's very, we can't answer on specific questions for specific issues in this area. Normally, we have people to contact our National Employer Help Desk. They're the first point of contact for any employer who has questions about the wage subsidy scheme and the employment wage subsidy scheme, both the temporary and the employment one. So they're the people to talk about. Now, I see your caller here, or your questioner here says that they've been trying to get answers from revenue. We have had a few cases, there was exceptional cases, some TUPE cases, or TUPE cases where and appeals where people were brought into the scheme on an exceptional basis. Revenue are going through the refunds, try to spend most of their time trying to get the refunds organised for prospective, in other words, going forward, and we're now working through the retrospective. There was quite a lot of issues around that because the people who, when they applied for the scheme, whatever technical issues that existed and created, you know, there was a backlog there, and we're working through those now at the moment. But I would say for your particular questioner there is to always get back onto the National Employer Help Desk and to find out exactly what the status quo of that is. The alternative is to go straight to the caseworker responsible for your particular employment, which in this case will be, well, I don't know who this questioner is, but to talk to their caseworker, whether it's a business division or medium enterprise or large cases division.
Okay, thanks, Gerard. So here's one that's occupying, or just to start this off, which is will income tax liability be shelved on the 31st of October for self-employed? I think possibly wishful thinking there, but so can the panelists cover income tax for self-employed solicitors and clarify what rules will apply for this year, a tax settlement date on the 31st of October, and how might tax warehousing apply in this situation? So there's quite a few questions around that.
Pat, do you want to take the tax warehousing one?
I'll take the tax warehousing. I suppose I can run a few slides through on the tax warehousing, give an overview of that. I'm happy to kind of deal with the IT filing. Essentially, IT filing continues as normal. I suppose it depends on the particular circumstances. In reality, with IT filing, the bulk of your liability would have been paid in your preliminary tax, so it would be the balancing statement. And if a business wasn't thriving particularly well during this year, well, then they shouldn't have a significant tax liability in terms of preliminary tax for next year. So it depends very much on the circumstances. But there is no change as such in the filing arrangements for IT as it stands. And IT is not, cannot feature under the warehouse scheme, because the warehouse scheme was specifically, or is specifically, for VAT and Prem. So what I might do is I might run through a few slides in terms of how warehousing works, and also mention this new PPA facility, which is basically has a very short lifespan if you want to get in under the covers of it. So, sorry there.
Guys, I know we've gone over slightly on the 30-minute session, but we're expected to.
Yeah, I can whip through it fairly quickly.
No, that's all right. We're happy to keep the call open just because it's such an important matter, and so many people there interested in and have queries around that. So if you have any chat queries, send them in to us. We'll work through them. And if so, over to you, Pat.
Okay, I take the slides are up there now, are they?
Yeah, we can see them. Yeah.
Perfect. Okay, I suppose essentially these two measures, they were brought in to ease the burden on businesses recovering from, I suppose, COVID, and try and make it as easy as possible for them. I suppose Revenue acted fairly quickly in terms of we paused enforcement, we put a stop on charging interest on late payment for VAT and Prem. We're very conscious of businesses picking themselves up off the ground. So really, I'm just going to quickly go through the rules or the mechanism around warehousing. So hopefully people will have an understanding of what falls in for warehousing and what you need to do. So the general rule around warehousing is you can warehouse all VAT and Prem liabilities that were falling due during the COVID restricted trading period. And then as a minimum, you can actually warehouse your first 2 months after you return to trading. So really the important thing is to understand what is this period. And I'll go through that in a bit more detail. I suppose a couple of other things you need to bear in mind is we have a variety of filing patterns, and that could be a little bit confusing. I'll give a couple of examples, hopefully, to clarify that. And also, the legislation as it came in, basically, it provided that all SMEs, essentially businesses that are in our business and personal division, automatically qualify for warehousing, and larger businesses, such as in the medium enterprise division and the large cases division, they need to apply and they can qualify for warehousing. And there is a very detailed booklet available on the website. That is the link to it there. People may already be familiar with it. And I suppose in some respects, this is warehousing and warehousing periods on one slide. And the whole warehousing concept revolves around 3 periods. And period 1 is essentially where you identify the liabilities that may be warehoused. And again, they are VAT and Prem. And to identify the liabilities, it's a little bit of a broken record on this, but it's really important to file the returns. And as we have said, in terms of earlier communications that have gone out, people may have difficulty kind of filing returns or getting access maybe to their agent, for example. In that instance, we're quite happy to take a best estimate. So it's really important to file the returns. As I've said already, it's automatic for business and personal division, LCD on application. And the end date is based on when you return to trading plus the next 2 full bi-monthlies. And this is really important to get into your head. What is period 1? So for a business that returns to trading, let's say, for example, in July, it's in the July-August bi-monthly period. So it's entitled to warehouse all up to July-August plus the next 2 months. So it actually can warehouse up to the end of October, the 31st of October. So that is your period. That's what you are putting in the warehouse, that lockdown period. You have a minimum of 2 months after you return to trading. If you return to trading earlier in a bi-monthly period, you could almost have 4 months of actual trading warehoused. And I'll show you an example in a moment. So now we've nailed down period 1, and that's when you identify what's in it. And then as regards period 2, that is the period in which the debt you have warehoused is sitting there interest-free for a minimum of, for 12 months. Okay, so you lock it down for 12 months. The main important point to make is businesses must pay and file current taxes. So you are now up and trading a number of months, and we're asking you to pay current taxes, and your historic debt in terms of COVID liabilities is warehoused. There is nothing to stop a business making payments against their warehouse debts during that period if they want to, depending on how well they're doing. There is no obligation, excuse me, there is no obligation to do so, but obviously it's going to reduce your liability at the end. Then after your 12-month period, so if we go back to our example of the businesses that's returned to trading in July, we said it's period 1 ended on the 31st of October 2020. The 12 months runs until the 31st of October 2021, 0% interest. And period 3 commences then for that particular business, and that is when it needs to either pay in full by that point or opt for a reduced interest rate phase payment over a kind of a reasonable period. We'll be quite flexible in terms of terms depending on the circumstances of the business. So those are your 3 periods of warehousing. Okay. I suppose the significance of the filing pattern then as well. So your periods, we take, for example, our period that ended on the 31st of October. What can be included in that? So it depends very much on your filing pattern, whether you are a standard filer or whether you actually have avail of the reduced filing pattern. So some of them, they vary depending on whether it's VAT or Prem. So for VAT, you can sometimes file every 4 or 6 monthly or annual. And for Prem, you can do quarterly or annual. So what can happen is you have a period that ends on the 31st of October. But how does that marry with your filing patterns? And really what it means is you get the benefit of the doubt in most instances. So if you're a standard filer, bi-monthly for VAT and monthly for Prem, it's quite clean and neat because that sits in within the period 1. It's just if you're in one of the other filing patterns, you might have part in and part out. And essentially, you're getting the benefit of the doubt for 4 and 6 monthly VAT and for quarterly Prem, in the sense that if any part of it is within your period 1, you're allowed to pull it all in. It doesn't change the end date for period 1, but it allows you to pull in extra debt into the warehouse. The annual filers are a little bit unusual. They depend. VAT is very, very unusual in the sense that you can have a year end at any point during the year, and there's a particular rule around that. I'm not going to confuse the issue further by going through it. I'm happy to deal with it if somebody wants to ask a question. Prem is a little bit cleaner in the sense that the annual is the full year. So if you are a Prem annual filer, irrespective of when you return to work in 2020, you can warehouse the full 2020. So maybe to try and make this a tiny bit clearer, I'm just going to give you an example of, say, Murph's Pub and Grub that returned to trading in July, and it's a standard filer, and by that I mean it files bi-monthly VAT and it files monthly prem. So it returns in July. This is more or less the example I was talking about a moment ago. It returns in July. That is in the middle of the July-August period. So it has the remainder of that period plus the next 2 months that it can actually warehouse. So it has at least maybe 3.5 months of trading debt it can also warehouse. And if we look at that from terms of VAT and prem, so it's all months of prem from February to October. The reason January isn't included, and that's part of the legislation, is that for this type of a filer, January prem should have been paid in February, and that predated COVID. So that doesn't come in for warehousing, but the rest does. In terms of VAT, your January, February VAT wasn't due until March, so that fell within the COVID period. So that's all in there. So if we take an example then, that's a little bit more complicated. So now we have...
interrupt you there for a second?
Of course you can.
There's a query there, is VAT shelved from March to October on that basis?
VAT shelved?
Yeah, you don't pay VAT from March to October.
It all depends on when you return to trading.
Yeah.
And your pattern. So for most, like the way we're looking at it, for most businesses, phase one was in May. So for any business, let's say that is definitely within our business or personal division, the SMEs, they are, as a minimum, should be able to warehouse all their VAT up to the end of August, even if they came back, even if they were trading in May. They have May, June as being the period they were back trading in, or if they were already trading, but where you get the benefit of the doubt there. And then you have July, August on top of that. So for that business, as a minimum, it has up to the end of August in terms of VAT it can warehouse. If that answers the question. Now, they may actually warehouse more depending on their filing pattern. So if you even take that, yes?
So if you weren't trading for that period, March to October, there is no VAT due. So yes.
There's no VAT due and you have nothing to warehouse, but you should still file the returns.
Yes, okay.
And bear in mind what you can, well, it depends then on when you return to trading, because whenever you return to trading, you have whatever part of that bi-monthly you return to trading in, plus the next 2 months you can warehouse. So you do have that buffer to allow you get up and running and warehouse the first couple of months of VAT debt.
Yeah, but just to state the obvious, because you've taxed warehoused for that period, it still means there's an implicit tax liability incurred that will need to be repaid at a future date.
Correct, except you have a year at 0%, and then you have a reduced interest rate compared to 10%, which would be the normal rate for VAT and prem.
Very good.
So that's a significant reduction.
And there's a query here around legal services. If the legal services never closed, the solicitor's firm, does tax warehousing apply to them?
Well, I suppose.
And then if it did close for a month or two, how would that apply?
What the view we would be taking on this is that under the government roadmap, certain businesses were up and running from phase one. So if a business is within our business, is an SME essentially, and if it did trade away at some level, but what we're saying is they definitely were up and running when phase one commenced on whatever it was, the 17th or 18th of May. So they are a business that kind of falls into that category. They were running up in May. Their period one, they're entitled to include their May, June, and their July, August, if we're talking VAT, and that's the end of their period one. So they can warehouse liabilities up to the end of 31st of August. Notwithstanding, they may have been tipping away or in a position to keep tipping away during the COVID period.
Okay. And then if you're able to demonstrate that you were closed for a certain period, the period would be longer, that you could warehouse more.
Absolutely. So if we take the example even of the DIY store, we have a DIY store, okay, that should have been up and running somewhere in the July-August period. If for some reason it can demonstrate that it wasn't up and running in the July-August period, maybe the employer themselves suffered from COVID or whatever reason, they were not in a position to actually start trading until sometime later, well then their period one is determined by when they did actually start trading, plus the next 2 months they can add in as well in terms of debt that can be warehoused. So clearly, as you said already, if they weren't trading, they're probably not going to have any liability, but it does mean that they're able to warehouse the first couple of months of trading and actually have that buffer, and then they don't have to pay that for at least a year.
Here's a question. Should VAT payments, should income tax payments be prioritized in relation to VAT payments? If you could warehouse your VAT payments and then make your income tax payments, is that
that would make sense.
Misunderstanding something there, or
no? You're not. I mean, you have the entitlement to if you are an SME essentially, or if you're a larger business and you have suffered trading. But let's say we're talking about SMEs at the moment. The legislation provides that SMEs qualify automatically for warehousing, so they have a judgment call to make in terms of how they want to approach it. I mean, as you did say, ultimately you have to pay that debt, but if you do need a bit of breathing space and you automatically qualify for warehousing, you can warehouse debt depending on when you returned to trading. You can warehouse debt plus your first 2 months as an absolute minimum, and then you can prioritize how you pay your other debts. Yes.
And here, kind of a straightforward question here, but period one, you can warehouse up to the end of August, but when does period one start? Is this from at the end of February? Or is
period one? It depends, and I suppose it really is important to get into to kind of nail down period one. Period one starts either in January. Generally, it starts in January. Let's say it starts in February for Prem, but look, it starts in January. It will end for most businesses on the 31st of August, because the vast majority of businesses were able to get up and running in the July-August window. So whenever you got up, in the May-June window. So whenever you got up and running in the May-June window, it doesn't make it anywhere between the 1st of May and the 30th of June. If your business was up and running in that window, your period one ends at the end of the next 2 months. So you have the next 2 months by default you can bring in. If your business did not start up and running until after the 1st of July, you are now in the July-August period when you got up and running, and you can bring in the next 2 months. It's important kind of to figure out when you started up and running, because a lot of the examples, and we're talking about May, June, and July, August, but it all depends on when the business got up and running, and that's the fundamental point you kind of have to nail down. When am I up and running according to the government roadmap? And if you weren't up and running in line with the government roadmap, you're going to have to come and tell us. So we're going to assume by default that businesses were up and running in line with the government roadmap, and their warehousing will be based on that. And the other critical bit, like in terms of, and I appreciate it's confusing, the other critical bit you have to kind of look at is, what is my filing pattern? Because if my filing pattern is unusual, like the quarterly, it doesn't actually marry completely in with the end of my period. But what we are saying is you can pull that in. Your period of the 31st, if I take, for example, the one we're talking about all the time, since probably a lot of people said the up and running May, June, and you include July, August. Now, actually, if you are a quarterly filer for Prem, August has the first 2 months of your third quarter. September is the final month in that quarter. You can pull in September into the warehouse, but your period one still ends on the 31st of August. So essentially, earlier debt, you will have it in there at 0% for 12 months. The September liability will be coming in. You have the bonus of being able to bring it in, but it doesn't change your end date for period two in terms of the 0% coming to an end. Have I confused you completely?
No, I think it requires probably a bit more detailed study and individual circumstances.
It does.
Yeah. Here's a query for you. If I got VAT, I wasn't aware of the scheme, I returned and paid it. Can I warehouse it retrospectively?
No, thanks very much.
Yeah. So
I'm afraid not. No, we wouldn't be refunding that in those circumstances. No.
Yeah. Okay.
I mean, if the business was in a position to pay, it was in a position to pay.
And I think this comes back to the fundamental point that once you warehouse it and push it away, it still has an underlying liability. So probably best to have paid it up if you could.
It does, but you have the year at 0% and you have the reduced interest rate when you do need to refund it. And I suppose
so would that affect the business though going forward from here if they wanted to tax warehouse, or does that depend on the period? So let's say I paid in phase one, I paid up my VAT and made the returns. Does that stop me from ever entering the scheme again?
No, well, you see, it depends on when you have returned to trading. I suppose this is the fundamental point. Like, I mean, at what point from May on were you trading? And once you figure that out, that's your starting point. When between May and now was I trading? When did after the 1st of May? When did I start trading? And once I figure that out, I look at which bi-monthly period that's in, and I add in the next 2 months on top of that as being my potential warehousable periods. And then I have to look at my VAT and Prem filing patterns just to see how much debt I can pull in there. But the fundamental point is, when am I back in trading after the 1st of May? And once you figure that out, you figure out the end of period one, and that nails down what can be warehoused. So if you have paid part of it, fine. If you haven't paid part of it, you can warehouse what you haven't what you haven't paid. If you haven't paid any of it and you have liabilities, you can warehouse the lot of it. And if you haven't been trading, you have really nothing to warehouse, but you still need to file your returns. So we know, even if you have a nil return, we need to get that in to understand. Otherwise, we may be going down the road at some point in the future, assuming there's a liability there and raising an estimate. So it's important to file the returns, and we all know where we stand then.
Okay, thank you. I know we're getting to the end of the session now, so unless there's a few last questions, I think we've tried to deal with as many of the queries around EWSS and tax warehousing as possible, and then the end of year income tax returns that they need to be paid, or sorry, they need to be filed, and then if there's an issue around payment, that would be negotiated on an individual basis.
Yeah, do you want me just to give you a very quick overview of the
Sure.
kind of
yeah.
base payment? So, just as I was saying there earlier, the warehousing is purely for VAT and Prem. But as part of the stimulus package, there was another incentive was brought in to help businesses to deal with debts that cannot be warehoused. So you have debts that, for a business that might be older IT debts, they may be debts for any tax set, or for older Prem debts, older VAT debts, they do not qualify for warehousing. So if you have those liabilities at the moment, you now have a very short window in order to get a phased payment arrangement at a 3% rate compared to the 10% rate. So this came in as part of the stimulus package again on the 1st of August, or the July stimulus package came in with the legislation on the 1st of August. But the critical point around this is you have to deal with those debts. You have to apply to have a phased payment for those debts, an agreement in place by the 30th of September, the 30th of this month. So it's really important that this is it's a kind of a Black Friday sale of a sort. Like, you apply online on Ross, and a bit like stealing a line from one of the other ads, like when it's gone, it's gone. But actually in this case, when it's gone, your interest rate is up to 10%. So this is an opportunity to get a reduced rate of interest. The critical point on this though is this is a reduced interest rate for the repayment period. It doesn't reduce your historic interest to date. You have your accrued interest to date, but if you can get a favourable arrangement over a number of years. In the past, we have been a lot stricter up until now, up until the COVID struck. We would be fairly strict in terms of amounts of down payments and the term we would give it for. Generally, we didn't like to give it beyond 2 years. We would be more flexible around it now. We would be very flexible around the amount of the down payment, and your interest rate is reduced to 3% over the lifetime of the repayment period. So, but that is it's in, and it just is. It was just something that was promoted by the government. But it's in for a very short window of time, and as I say, when it's gone, it's gone. In practical terms, you can apply online. You just have to ensure, again, a broken record on this, that your returns are filed. You can specify the down payment. You can see the number of repayments. You can actually play around with it and see what you can afford. We had a higher bar as regards supporting documentation. We're far more flexible at the moment. So in the current circumstances, and you can, as I say, it's an online process, and you will get a response online very quickly. I'm just going to show you the next slide, just by way of...
Just a quick question on that previous slide. Will that apply to income tax payments, or is it just the tax warehousing scheme, that flexibility?
No. This is not the tax warehousing scheme at all. This is debt that doesn't qualify for the tax warehousing scheme.
Okay.
So this is any debt that is due. The fundamental, the most important thing is A, returns are on file, and that the debt is due. So the difficulty, what it means is any debt that is due by the end of September, you could include there. So if a debt isn't due, you can't include it in a phased payment arrangement because effectively you don't owe it. And in terms of the IT for 2019, which is due on the 31st of October, that is not due until the 31st of October. So we can't do a phased payment arrangement on that. But any older debt, previous income tax, PREM or PAYE or VAT for previous predate COVID, if you qualify for warehousing, you can get a phased payment arrangement on that. So you could be in the situation that a business, for whatever unfortunate reason, okay, it has COVID liabilities that it can warehouse at 0% for the next year. It has non-COVID liabilities that it cannot warehouse that may predate COVID. Or you could have a corporation CT that was due, depending on your filing pattern, earlier in the year. So if it was due because your end of year pattern made it due earlier in the year, you could actually include that in this phased payment arrangement at 3% over the lifetime of the arrangement. As I say, the accrued interest is locked down, but it's the interest over the lifetime of the repayment period that is at the reduced rate of 3%. And just by way of example, if this is a range of actual phased payment arrangements that you might be looking for, and the significance of what it would mean over the lifetime of the arrangement. So in these cases, the down payments are very small. They're sort of 100 or 400, really in there to kind of make it easier to work out the figures, but it's relatively small in the scheme of things. And if you say even pick one around 50,000, your savings, if you go for a 3-year arrangement, are 5,000, 4 years almost 7,000, 5-year 8,500. So that's a saving in interest over the lifetime of the repayment period by opting for this reduced interest rate. Again, obviously the saving is going to depend on the size of the phased payment arrangement and the duration, but it is a saving over the lifetime of the repayment period.
Okay, Pat, that's great.
I suppose just to tie it in with what Siobhan and Gerard were talking about earlier. I mean, this is your window into EWSS if you require tax clearance. So if you can't get tax clearance because you have debt outstanding, you need a phased payment arrangement. So you can get a phased payment arrangement after the 30th of September still, and you'll have missed out some of EWSS. But your phased payment arrangement at that stage will be for at 10% over the lifetime of the arrangement. If you get it in earlier, you qualify earlier for EWSS, and you actually qualify for a reduced rate of interest. And it also applies for the stay and spend scheme providers in the sense that they need tax clearance as well. As I said, flexibility regarding the down payment and the repayment period. And I would also point out in terms of the phased payment arrangement, once you're in it, there is a reasonable degree of flexibility to accommodate the difficulties people might encounter. So, for example, you can quite easily defer it for a month if you're hitting a problem, but we have a facility to defer it for up to 12 months if somebody hits a complete roadblock once they've committed. So, you know, we do realise that people kind of commit to these things in good faith, and in the current climate particularly, let's say a second block of lockdown hits or something hits a particular business and they can't make their phased payments, we will defer if people come to us and talk to us, and we can defer it, as I say, for up to 12 months. And again, there's a good deal of information. That's a link to the revenue website on the last bullet point as well on that slide. So it's important from the EWSS.
Yeah, sorry, quick question on the interest rate. Is over 3 years, is it 3% an annual percentage or a total percentage?
No, 3% is the annual percentage. It's a daily rate that's in the legislation, but it works out at about 3% per annum.
And just, I know we're coming to the end here, so if there was any final questions, but we'll probably look to wrap up. Listen, it's been immensely helpful. We've tried to cover as many issues as possible. I suppose just going back to the EWSS for a second, this kind of query around turnover and orders, just there's still queries coming in on that. So somebody's saying that there's a SAP standard accounting practice that defines turnover. there is no SAP that defines new orders, this will be problematic for EWSS. But coming back to you, Anne, I think you're quite clear that there's very specific terminology laid out as to what how EWSS terms turnover.
Absolutely. It's, as I've already said, it's clearly set out in the general accounting standards on how turnover is actually accounted for.
Yeah. So listen, everybody, we will send out a recording of today's information session. We will also try to share the slides, if that's okay with revenue. And if you have any additional questions, you can contact me. But just listen, a big thanks to the revenue team there, Anne, Gerard, Pat, Siobhan, and Laura for spending some time with us today. So we've really asked you a lot of on the cuff questions, and you've come up with all of the answers. So thank you very much.
Thanks very much, Justin. Just one last thing very quickly. Somebody asked a question there about CA24. It's going live, planned live for the 14th of September with comms and e-briefs to issue.
Do we just deal there, sorry, Gerard, with that last, does a drop off in instructions in litigation matters count for a reduction in business? Does that?
A drop off, yeah, it's back to the same thing. It's back to your general accounting practices or standards determining your turnover for your test for eligibility.
Okay, everybody, listen, thanks a million again to Revenue, to Anne, to Gerard, to Pat, to Siobhan, and to Laura, and to Maeve Core, who put us in touch. So thanks, Maeve.
Great.
Thank you, everybody.
You're very good. Thank you very much.
Thanks, William.
Thanks.
Bye-bye.
Look.
Bye.